Hi, welcome back to the part 3 of the chapter 1. So we have talked about the financial statements in the part 2, how did everything flow through. And right now we want to talk to you about learning object 4, which is describe the role of financial accounting in the decision-making process. So in the beginning of the overview section, we talk about the 3 functions of accounting. And then in first chapter, the first 3 learning objects, we talk about the measurement, communication. And right now, we're trying to tell you a little bit about the decision-making process, the function of a financial accounting decision-making process. So let's look at this interesting cartoon or graph. It's actually saying that the economic activity is at the bottom, which is most complex and daily and granular level of economic transactions. And then accountants who apply accounting judgment to recording them in a scientific way to summarize and recording these accounting transactions. And then accountants in the accounting financial department summarize and put them together into a useful information. And such useful information is actually used by the insiders and outsider external users who have the decision right and wanted to make a decision whether to invest in the company backward, And then if the decision here, if the financial information here is very useful, it will help the people make a good decision, wise decision. Hence, the consequences of the decision is positively influencing the economic transactions at the very, very beginning, in the ending, right, in the receptive end of the whole process. So this become a very positive circulation of information transition into a cycle. Hence, the accounting serves an important role in a prosperous society by measuring the activity and communicate very useful communication information to the important users and help them to make good decisions. And accounting is not only about adding and subtracting. Accounting, you need to practice a critical thinking ability and then to make correct and wise judgments. So let's give you example. So the most important prospering economies in the world today are structured around free markets, which in the free markets means that it's not government-controlled markets such as stock exchange, and firms are allowed to competing with each other, and the customers are free to choose the variety of products and services from whatever or whichever company that they prefer. In this example, such as Dell or HP and Apple, so you can freely to choose whatever you like. So in terms of the company, can these companies offer you, who are customer, the laptop of a computer that you want for the price above their cost? Because everybody have a different price point, right? And you want to choose the computer that fits the best for your needs. So if if the companies can able to discover your needs and may be able to find the competing edge to charge you the amount that you're willing to pay, at the same time they are able to keep the cost down. And then in that way they can earn profit. And then if they earn profit, they can stay in the business. However, if they are losing the competition advantage, or the cost of the goods is too high, or they are not able to find what the customer needs, at the end they will lose the competition advantage and they will incur costs, and eventually they'll go out of business. Hence, the successful companies use resources very efficiently to sell the products and services for profit. For a company that is able to make a profit, the investors and the creditors, right, they need to understand how to transfer those resources, how to use those resources, and to how to expanding the company into a profitable division or operation. And all these things, information of successful companies, how did they identify themselves? How did they make themselves successful? How did they get information that needs to differentiate themselves from the unsuccessful companies? And then able to help those investors, the creditor, put their assets and the capital into a correct firm instead of wrong firms, which is gonna eventually go out of business. This is all because accountants are providing a critical information that to help them to understanding the current status of the company. So investors and creditors rely very heavily on the accounting information in the investment and lending decisions. Hence, accountants serve a very important role in a society, as we can see, and by measuring the economic activity correctly and communicating very useful information to critical parties. Okay? And then I just wanted to give you a very interesting phenomenon or linear relationship between the net income of the company and the investment value. So on the left-hand side of this graph, okay, we call it a rectangular graph, you have a y-axis and x-axis. The x-axis is actually representing year, right? The y-axis is representing investment value of the company. And what this graph tells us that if the company have initially, you as investor has initially been invested in this company for $1,000, okay, and over the 20 years from 1997 to 2017, if this company is with positive or increase in net income, the value of your investment is growing up. Right? However, if you happen to investing in a company have a decrease in net income, okay, over the 20 years, the investment value of this $1,000, as you can see, is decreasing. Okay, so in another word, as investors, you are looking for companies who, whose stock is likely to increase, right? Because if there is an increase in stock value, right, that means you can make money. You buy it at a low price, and then the price goes up, then you make the difference, right? So you want the company's stock price to keep growing. And then is there a way for you to find such company out of so many thousands, hundreds, thousands of company to differentiate what is the profitable, what is a good investment, what is bad investment? And I will tell you that this piece of information is most important thing that you need to remember is that no other single piece of company information better explains the company's stock price performance than does the accounting information of the net income. So in another word, net income has the most direct relationship with how the stock price is gonna goes up for next quarter or next year versus goes down. Okay, so the bottom line of a firm is that we remember in part 2 we talk about the revenue minus expense is either positive or negative. If it's a positive, which means the net income is increasing, the investment value of this company is positive, right? If you invest in a company who has a net income is negative, over the 20 years, this company is going down, okay? So this just demonstrating the most simplified relationship between why accounting matters, why we care about financial accounting information. Because if we look at the income statement and they are making money, they give us belief that in the future this company have earning ability, profitable earning ability, right? So investors and creditors also use information reporting in the balance sheet because they consider a company's total liability often refers to total debt. Expanding debt limits the management's ability to respond so quickly and efficiently to business situation. So because when you have too much debt, the debt contracting, the bank will have a lot of restrictive covenants or contract items to block you to do anything that you want, because they are afraid of you do not have enough cash to pay for interest or pay for principal. So you are pretty confined by the legal obligation of repayment and restrict the management ability to engage in new profitable investments. Hence, besides net income, in the balance sheet, the debt level, the overall debt level, debt ratio of the leverage ratio of the company is also very important. It is representing the riskiness of the company. So with that being said, I just want to tell you that the financial accounting information is widely, heavily used by investors to pick a winning company out of a losing company. Okay. So then we are moving on to financial accounting information. So the learning objective 5 is trying to tell you that what is the accounting principle that we use. So you will ask me, what is accounting principle? Why does that matter? Accounting principle is a set of rules that accountants comply religiously, trying to digest the transactions that happen on a daily basis and translate them into a financial report. That's why accounting is business language of business. So if you can speak language of business, and then you can start to understand the business. And so what is the general accepted accounting principle? So first of all, if there's a principle, there must be someone make those principles, right? So financial, then the entity or the government entity or private entity that making financial accounting standards is the ones that evaluate whether the information is useful, whatever the produced based on the accounting principle, right? So because financial accounting information is so vital to investors and creditors, and a formal set of accounting standards have to be established, right? So make decisions based on financial information. Hence, the financial accounting information should be based on the formal standards called General Accepted Accounting Principle. And then you ask me, what is General Accepted Accounting Principle? General Accepted Accounting Principle is actually a set of accounting standards is created by the FASB. We call it Financial Accounting Standard Board. This board is a group of people. It's an independent and private sector body with a full-time voting members and a very large support staff. Members including representatives from accounting profession, large companies, and financial analysts, and accounting educators, and government agencies. So this group of people, which is called FASB, thinking about way to calculating the transactions and publish those standards. That way every firm will comply with the standards. And this standard board is in United States. Comparatively, globally, a lot of people adopting international accounting standard boards, which is a global counterpart of FASB. It's called International Accounting Standard Board, and in many ways, this organization functions as FASB, and they not all the countries should following International Accounting Standard Board, but the majority of European companies or European unions is following International Accounting Standard Board. And then, specifically in the United States, this Financial Accounting Standard Board is governed by the Securities Exchange Commission. What is the Securities Exchange Commission? It is a government agency created in 1934, and it has the power and the responsibility for setting up the accounting and the reporting standards for companies whose securities are public traded, and the SEC has delegated the primary function for the setting accounting standard to FASB. So SEC has authority to in charge of the standard setting, but it gives the authority to the Fed to making the standards. But because the power is in hand of the SEC can reject any standards that Fed will come up that SEC don't think is appropriate. Okay, so the most important point that you need to remember is that the rules of financial accounting are called General Accepted Accounting Principles, and the FASB, which is Financial Accounting Standard Board, is an independent private body. It's not a government-based; it's an independent private body that has primary responsibility for establishment of a GAAP in the United States. And then when we talk about financial standards, we have to talk about auditors. Why is that? The reason is that since it's so important to comply with the government SEC FASB standards, and then the accountants sometimes they might not be able to follow the standards to creating a lot of financial information. In those cases, there's a group of people called auditors. These auditors are trained individuals hired by a company as an independent party to express their professional opinion of the extent to which the financial statements are prepared in compliance with GAAP and are free of material mistakes. For many businesses, there is a natural separation between the owners and the ones in charge of daily business. The owners essentially is the investors, and the ones charging daily business is the management. So this separation created a problem here because the people who manage the business might not be honestly reporting or do honest reporting to the owners, right? And then so this is why it's important to have a financial standards that's to govern how the management report to the outsider people who are the investors. And then but when during this communication process, investors and creditors might not able to 100% oversee management behavior. And then that's why they need an independent party outside of the firm to verify the financial information quality of the firm. Such independent examination is done by auditors. Right? So auditors' role has two major functions. One is to help ensure that management has in fact appropriately applied GAAP in preparing their company's financial statements. Another role is that it plays very vital roles in investors and creditor decision making by alleviating their anxiety and doubt about whether the information they read provided by management is accurate or is useful or is faithful, right? So auditors, if auditors find any mistakes or fraudulent information behavior, they will require the company to correct all the significant information before it publishes their financial statement to the outside investors. Hence, the auditors play a very major role in investors' decision making by adding credibility on top of that, right? It's a separate pair of eyes to double check what the management information has been provided, whether it's accurate or it's ethical. So I just want to give you a quick example of what it looked like in terms of auditor's report. As you can see, this is a financial report from independent auditor's report who audited the Dick's Sporting Goods. It's communicated to board director and stockholders of Dick's Sporting Goods Inc., right, in Pennsylvania, Pittsburgh. And then this independent auditor said, we had audited a company consolidated balance sheet of Dick's Sporting Goods Inc. and subsidiary as of January 28, 2017 and January 30, 2016, right? So they said, we have looked at your report, which is prepared by your management for year 2013 and year 2017 and 2016. And they said, look here, highlighted in red. In our opinion, in the auditor's opinion, such consolidated financial statements present fairly, in all material respects, the financial position of Dixon Sporting Goods Inc., a subsidiary as of January 28, 2017. Hence, the result of operation and their cash flow for each 3 years in the period ending January 28, 2017 is a conformity with the accounting principle generally accepted in the United States. So these two sentences highlighted in the red tells me one thing. This firm's information are trustworthy and is complying with GAAP, which is a good thing. Okay, so I just want to do a quick summarization about what is the financial accounting should provide, what kind of information should provide. First of all, financial accounting should provide information that is useful to the investors to help them making decisions. Second, this information needs to help them to predict the cash flow, right? That can help the creditor to assess the debt paying ability. And also, financial information also tells economic resource claims to resource and changes in the resource through the balance sheet, like how many economic resources the company currently have, what happened to them, it's increasing or decreasing. Okay. So, and then I just wanted to spend just 5 to 10 minutes talk about the career in accounting. So whether you plan to be majoring in accounting or not, this section is very important to you. Because accounting majors need to realize that many different options available upon your graduation. And those who do not plan to do a major in accounting need a solid understanding of many different business decisions involve accounting information. So one of the greatest benefits of an accounting degree is that you have a wide variety of job opportunities, and that opens to you. And with an accounting degree, you can apply for almost any position available in a finance major, but I cannot say the same to the finance major students because finance major finance major students might not be able to qualify as accountants, but the accounting major students can definitely work in a finance department. And so I just want to give you a brief view about what kind of job out there. So first of all, you have to have an idea about what is a public accounting and what is a private accounting. Public accounting is firms that are professional service that traditionally have a focus on 3 part of area. First, we talk about auditing. People in public accountants usually they work as auditor, or they work as a tax preparations or tax planning. And 3 is that they could get business consulting services. They can involve in the advisory services. And because auditors is a very important role, who needed to express their opinion on whether the financial information is in conformity with the GAAP. And tax preparers actually is increasingly important in the United States because the complexity of the tax laws related to the personal and the corporate tax continue to increase, that creating abundant opportunity for accountant major to become a great tax preparer or tax lawyer. And the business consulting role is also very lucrative option for the accounting major students. Besides, in a public accounting firm, you can also choose to be a private accounting firm. Your employer could be 500 Fortune company. You can work as managerial accountant analyst or financial reporting analyst who you serve for your employer within internal reporting. And in public accounting, you look at the external reporting financial statements. And also in the public accounting firms, there's the Big Four firms and non-Big Four firms. So Big Four firms is representing Deloitte, Ernst & Young, PricewaterhouseCoopers, and KPMG. And these 4 firms audit almost all the 500 Fortune companies. Okay, and they are huge, and their revenue is in billions, and they hire thousands of accounting graduates major, and they hire thousands of smaller international, regional, local companies to help them to conducting auditing or tax services. And then in these firms, you needed to become a CPA, which is a certified public accountant, and then you need to take four exams. This exam break down in 4 parts, and also in some states you need a little bit working experience. Once you had a CPA certification, you are unstoppable in terms of a financial accounting career in the future. Okay. And the CPA can boost your beginning salary, and it's gonna help you in long term. I think the study conducted saying that the accountant with CPA versus without CPA is about a 20% difference in annual salary in 10 years down the road after you graduate. So that's why accounting already provides you a lot of choices in the future once you graduate, and then you will never find there's a limitation in the possibility of you find a job. And a career in private accounting mainly trying to providing accounting information services to your employer, right? And then you can become a financial accountant, managerial accountants, internal auditors, and tax preparers, payroll managers. All those are very important jobs in terms of helping a business to grow. And there's also other opportunities available, such as you can be a financial planner, you can be a tax lawyer, you can become environmental accountant, you can become investment bankers, because understanding the business language, you knock a lot of doors open. And even possibly you can become an FBI agent because you're very detail oriented and you're very logical, right? And so accounting can open a lot of doors for you. Okay, so Object 7 is trying to tell you that in terms of the financial standard boards, what they think is important in terms of financial accounting standards. So because when you're creating certain kind of rules, what you consider most important things to convey, right? So this is a concept about what is qualitative characteristics of financial standards, what are enhancing qualitative characteristics of accounting standard, what is the cost constraints, what is the underlying assumption. So fundamental quality of financial standards is actually whether the decision is useful, right? Decision usefulness it meant that the ability of the information to help the investors, lenders, and other parties to make an important decision to provide funds for the company. So if you had a set of rule that produce information that is not the information decision useful, then you are failing the most important fundamental characteristics of a financial information. And then the two other fundamental, and then besides information usefulness, it breaks down into what is information being useful, being decision useful. It got to fulfill 2 requirement quality. It got to be relevant, and then it got to be faithful. So what is relevant? The relevance means that accounting information should possess confirmatory value or predictive value to be relevant, meaning that if I read this information, I can come up with the conclusion that what is the measure is what happening to the last period of time, or 1 month, 3 months, is able to calculate, to be summarized, to be confirmed. And also, after I read those information that you gave to me, right, I can have ability to, based on this information, to predict the future of what's going to look like. And also, this information is not every granular information you report to me is the information that's important and material. That's what we call a relevance character. And at the same time, besides relevance, we need those information to be truthful, to be faithful. And what is the faithful means? Faithful means 3 parts. First of all, it has to be complete. You got to tell me the whole story. Second, it has to be neutral, meaning that you will not have emotional narratives in terms of blame this firm to doing bad, or have a bias saying that this firm doing really well. It has to be neutral. And the third one is that this information cannot contain error. The error that is not saying that 100% error free, but at least the material part of it has to be error free. So that's what contains the most important quality of accounting information. Okay. And the key points that you need to take away from this is that to be useful for decision making, accounting information should have relevance, right, and faithful representation. And then we wanted to say that, okay, general accepted accounting principle that developed by FASB, and then what are their underlying assumption to come up with such man-made, handmade, or manually made standards that is not scientifically, there's no theory behind it. It's how did they come up with this kind of standards? They come up with these kind of standards based on 4 assumptions. The first assumption is it's economic entity. Second is that there's a monetary unit that you can record. And the third is that there is a periodicity between one period to the other. You can divide the history of transaction time into periods. And also, this firm has to have no going concern problem. Going concern means going future. Future concern means that am I concerning this firm is still existing next month? So these assumptions are used by financial accounting standard boards to come up with the gap. So to help the business to record all the essential transactions into a financial story. Okay, so I basically go through the chapter 1 slides with you. I will have a quick small video that asks you several interesting and simple questions that maybe you can answer. So I will see you in the summary and the question quiz video for chapter 1. Thank you. Have a good time. Have a good day.